Even in an AI-focused world, MacroEdge is in the business of focusing on you. We don't just understand our clients, we listen to what's said and illuminate on what's not. In a world moving at the speed of light, with shifting markets, evolving workforces, and non-stop disruption, MacroEdge helps you to navigate and identify novel opportunities, expand your enterprise, and succeed in tomorrow's world. And it all starts with you. Put your enterprise and your perspective in the driver's seat. We're in the business of you.
Okay, let's try this one more time. Sorry about that, everyone. X decided to dump me. Perhaps he shouldn't have paid all that money to his lawyers to defend the case and invested it in infrastructure for X so he could have a functioning social media app without all the problems. Welcome one, welcome all. We're in the middle of a war. We have a major crisis developing as we speak. Markets finally took a substantial dump. We're going to talk about all of this with our fantastic guest, Samantha LaDuc, tonight. She is one of our favorite guests because Samantha doesn't screw around. She gets right down to the hardcore reality of what we're facing. And what we're facing right now is a market that's technically broken, a geopolitical, I'm sorry about that. And I apologize, Samantha. I'm in a hurry. Samantha LaDuc, excuse me. I guess that's my fault. Samantha LaDuc, we are dealing with a market that's broken, an economy that's breaking, and a situation that is extremely frustrating for the average soul. And if you're a retiree, you're thinking your investments are safe. You're thinking that things are going to go well and that the government will always have your back. There's a point in time in markets, economies, and macro that it just implodes in your face. And everyone thought in 2008 we're all going to be made whole. And the only people made whole were the banks. The only people made whole were those who were the wealthy contributors. It's going to be the same playbook again. And Samantha LaDuc provides the tools to avoid being caught in that trap, being destroyed by the markets, being destroyed by geopolitics. And tonight, we're going to dig into this really heavy. We'll start with markets. Samantha, welcome to the program. Can't you hear me? Oh, wonderful.
Hey, thank you.
There we go. Samantha, I apologize. I do that every time. And it's just like X is frustrating the hell out of me as far as being a host.
We're all together now. All right. So you can
Amen.
hear me, no problem.
We got you now. Let's go ahead. What's your take on the market activity this week and what we've seen over the last 4 weeks as we've evolved and devolved into a direct military conflict in the Middle East, which they try to sell to us as something that won't impact the global economy, but we're seeing the visible evidence they're full of it, and worse, the impact on our markets at this time?
Well, in a nutshell, it's time. So basically, the market underneath the surface had already started to wobble and go sideways the past few months. So there's already some skittishness about something afoot. In other words, distribution. And then obviously, we follow each other closely. So, I got the trading gut vibe in early February that it was time. And I actually warned clients, protect now or just let it fall. I'll let you know when it's safe. We actually didn't get selling underneath the surface and this really breadth destruction until March 3rd, which was obviously after Trump Netanyahu went to war with Iran. And I had just posted a big macro research note for clients since I run a financial research firm with a group of 10. But my note was Iran risk is not priced in. Iran escalation does not look easily winnable for Trump. It looks like a bluff inside a trap, which sets up a dangerous game of concession or consequence. Few weeks, later, a few days later, 2 weeks actually, the 28th, they obviously started dropping bombs. And this has been, for the bulls, a backdrop of, it's all right. Wars are bullish. You can kind of look back and see you have a little bit of a pullback, and then it gets bought because sadly, destruction creates production. But the bulls weren't looking very closely at this very large ramification of a regional war in Middle East being protracted and more than theater, more than just a weekend rendezvous. This was really going to potentially trigger an Arab Spring 2.0. At least that's what I wrote about back in mid-February, before this really got going. So one of my themes around this wasn't just that this was not easy to win, but that in fact it was not winnable, and that this would trigger the Gulf Arab countries, the GCC basically, of disinvestment, and it could be a real left tail event for unwinding a lot of their positions in the AI ecosystem. In other words, tech, and also their treasury holdings. So that was kind of the risk to look for. And then, of course, we had escalation on that weekend. And then we had, of course, follow through. And now we have a martyr in the Ayatollah Khomeini's death. And then we have constant expansion of this war in the neighboring Gulf countries, who are now in great despair as it relates to infrastructure damage, food insecurity, not just the global fuel that has powered this peace. And basically, this is what we have major league disrupted. And even with any potential ceasefire, which I don't see coming, lots of talk by Trump, but basically I see nothing durable. You get this situation where even to go back online for the LNG and production, it's going to take many months. So it exploded with this bullish bent. I don't know if it was a MAGA held kind of belief that this would going to be this imperial reach that would be good for America. But for the rest of us, it was absolutely overreach. And my crude oil price target hit. And now we've got semiconductors coming under disarray because of sulfur and helium and other products that are absolutely critical in the manufacturing. We have allies that are against us, literally. And I think the torpedo that's still headed for the US stock market finally is starting to show up, which is, in fact, disinvestment or de-risking in our AI tech ecosystem. So as far as I'm concerned, it's not over. Oil and VIX always overshoot, but basically we're finding shelter right now from war and capital outflows, and it's not done.
Well, let's start dissecting the technical side of the markets first. And one of the things that is an under appreciated part of the markets, and I know you keep an eye on this out of the corner of your eye, the MOVE index. Most people ignore it. It doesn't mean anything to 99% of the public. The volatility indications coming from our treasury market are creeping up rapidly towards 2022 levels, with a close at 108 today, by the way, boys and girls. If we start seeing increased destabilization of the bond market, is this not an indication that we have a larger liquidity squeeze risk in the forward weeks ahead as this conflict re-intensifies?
Correct. This is 100%. So technically speaking, we've actually rolled over, and clients know this, into my 6508 level. Ironically, we overshot today to 6475, which is basically a JP Morgan collar for those who are option savvy. And it's $1.5 billion collar that basically served as a little bit of interim support. And then, of course, Trump came out with this talk of he's considering winding down Iran military effort, which he then reversed, by the way, this evening, and says remains focused on total victory in Iran. But the point is, this agent of chaos we can't trust. So what we can trust, however, is that this is a technical level, for me anyway, that I've been looking for, is where intervention should come in right now. In other words, ceasefire should come in right now, even though I wouldn't trust it. It is something that could cause a bounce, trap the bulls again before we roll over, or we just crash. So this is, in other words, my crash level. And one of the reasons why I gave that crash level is more than just technical. It was this panic is justified. I wrote about March 8th. right? And the focus was not just talking about the tipping point in sulfur and helium and fuel oil, and this whole debate about ensure those in the Strait of Hormuz versus ensure their safe passage, but it was very much focused on these oil shocks are inflationary and recessionary. So what I'm looking for is actually levels where this entire exercise of Iran basically lasting and winning over the Trumpisms is ultimately higher oil equals higher dollar, higher yields, higher dollar yen, higher inflation expectations, and with that lower AI investment and lower markets. So I gave levels literally back in early March of where this would head. And I know it's a little scary, but there's something that happens when you have sustained higher oil. 5 out of the 6 times in the past where we had sustained oil above $100, we had recession. Another thing that happens, obviously, wars are inflationary. And this in particular, as long as oil, my thesis anyway, that I wrote for clients at the beginning of March, as long as crude oil stays above $80 sustainably, it is absolutely going to pull global yields higher until market crashes. This is a quote. And my baseline was this. At the time, we were about $90. That equals the 4.2% in the 10-year. So then I wrote, for every 10% increase in oil, yields can rise up half as much, or about 5%. So assuming $100, US dollar, by the way. So as the dollar is firm right now, we haven't gotten over a key level, which is 100.5. That is where it will move up faster. But as yields are moving higher, oil actually, crude should be higher. They're trying to suppress this like crazy. The Jones Act, right? Besant came out today and said, we're going to give even Iran oil passage because we need some global oil supply in order to calm things down. They've got futures that they're manipulating. There are lots of levers that they are trying to pass, removal of sanctions on Russian oil, et cetera, et cetera. So they're trying to keep things under control as it relates to the price of oil, but yields are saying, we know that's a game, and yields are rising. So my level was basically that we're going to be very quickly into 4.86% on the 10-year. So it's the rate of change in oil's advance can accelerate funding stress. That drives global yields higher, but in particular, U.S. yields. And we do not have a backdrop that's disinflationary right now. So the whole point of rising yields, rising dollar, and rising oil is in fact a major headwind to equities. So finally, over 5 weeks ago, what Iran risk is not priced in, it's finally getting priced in.
Well, let's peel this back a little bit, because you hit a great point. And folks, this is going to scare you, because what you just said about a 486 on the 10, we don't see 10 basis point moves in treasuries very often, do we, Samantha?
No, and it's going to go above that. That's just my starting point at 120 for WTIC. We're going to be at 4.86% very soon. And
you see that?
Oh yeah.
Yeah, game over for the housing industry.
Well, I don't know if it's game over then, but it will be as it moves higher. So this is actually just the level where we start to see this shake, right, before more. And above 120 crude, we will get much higher 10-year yield. So they have to do something. So, but what are they going to do? Right. You know how wishy-washy this is. And even Besant, who literally just came out and said, we're going to encourage, we're going to find the exact thing that he wrote. Just one second. He's talking out both sides of his mouth. I'm actually going to tweet this now, so it's out. But basically,
yeah, he was good at that today, by the way. Unbelievable.
Yeah. So I mean, you talk about that.
Yeah, I mean, you and I were talking about this, and it's like, He's saying that they're the global sponsor of terrorism, but we're going to give them a short-term waiver. Does this mean we're giving a short-term waiver for them to do short-term terrorism? It's the most asinine commentary I've ever heard in my life. And it is talking out of both sides of your mouth. We're going to bomb you, but you can ship oil to buy more weapons.
And not only that, but this is Bessent saying that we're going to ease these oil sanctions, permit, Iranian crude and refined products into the United States. At the same time, quote, Iran will have difficulty accessing any revenue generated, and the United States will continue to maintain maximum pressure on Iran and its ability to access the international financial system. Make sense of that?
You can't. And you hit it perfect, Samantha. And the biggest issue that I see here is, please speak to this. I don't play in the big boy sandbox anymore, but the big boys, you see the distribution patterns in the daily trading. You see distribution across assets all over the equity market. Retail still believes in the taco theory and is trying to stab at a bottom, and also looking to sit there and keep buying, thinking the AI trade isn't dead. Guys, you got evidence of what happened to AI in the Middle East. It was bombed out of existence and functionality. What makes you think natural gas at 20% higher is going to make it affordable to have these giant data centers in the United States? Are you seeing the same distribution patterns I'm seeing?
Oh, absolutely. And more than that, because it's global. It's not just the AI investments that are getting hit or the bulls that are on parade still. Again, some are just real Trump supporters and believe that this imperialistic reach is going to be good for the US. Others are looking at kind of historical relevance as, wars can, like I said, like hurricanes, they can destroy. And then you have to spend lots of money to build it back up, but not foreign wars in this particular case, where we have a ridiculously out of control fiscal spending that is building up higher and higher term premium because bondholders are demanding this in exchange for this inflationary expectation. But when you talk about retail keeps buying the dip, it's not just retail. So I follow quants very closely. Charlie McGilligan of Nomura, brilliant. Hartnett, brilliant. And they are both have been very much bullish about this right tail opportunity, which is how you can have a fast and furious rally, kind of like we had at the bottom of the April 7th low when we had dropped 20%, which is a typical correction, right? And then Trump and Bessent came in right after the 10-year auction on August 9th, which was at 1 o'clock. I remember specifically because I'm watching all that stuff and I run a live trading room. And the point is they intervened and they said, you know what? We're just kidding. We're going to put off these tariffs. And that created that 10% intraday trough to peak reversal. So they're looking for this type of right tail event, which is getting, I have clients in my room. When can we buy the right tail, right? Because they're outsized, out of the money calls that produce ridiculous gains when it happens. But you need policy intervention for that to happen. It's not just going to be a technical bounce. We're at a beautiful technical bounce level at the 6,500, doesn't mean we're going to. So we have to have policy intervention. So I'm constantly on the lookout for, it isn't retail that I care about, or even the institutional, gurus that are saying buy, buy, buy. And they've been saying it all the way down. So they're wrong. Retail is wrong. So we have every reason to sell off. We have bid volatility. We have firm dollar. We have, I don't even mean all the, the risk of what's happening globally and in the Middle East. This could be humanitarian crisis. This is not priced into the market. What they price in are the Fed rate cuts that are getting priced out. And it was something I had said in early January that I said, we're going to move from a liquidity drives the market into inflation drives the market this year. And specifically, they're going to go from rate cuts to rate hikes by the end of the year. Well, that's been pulled forward. Before Powell even got on the podium Wednesday at 2:30, and said, of course, it's 11-1. We're not gonna do anything, right? We knew that was a nothing burger, and he's not hawkish or dovish. He's just waiting because they can't predict what's going to happen with the war and inflation and the labor market and so on and so forth. But the market, the Fed funds rate started pricing in a chance for a May hike. So they're building and now it's bigger. Right. So the more or the longer oil stays elevated and yields rise and market sells off, and soon we're going to have credit spreads starting to blow out, widen, I should say, before they blow out. This will pull forward, this concern, and rate hike odds start to get priced into the market before deflation hits. That's later. First, you have the yield spike, you have the dollar spike that follows the oil spike. And then later you have a deflationary impulse. We're not there yet. We got to get the inflation impulse priced into the market. And that's just starting to happen literally since I can tell you exactly the day it happened, March 3rd. March 3rd is the first day that the market started selling underneath the surface. And breadth had started rolling over and it hasn't stopped. So retail is looking for the right tail, but they're not waiting for it. And we're looking for policy intervention, but what on earth are they going to do to really create peace in this region? They have no plans of de-escalating. He talks, the both of them, Trump, dissent, they talk about out both sides of their mouth. They're deploying troops now, right? They're trying to figure out how to get control of Karg Island, which, by the way, you have to go through the Strait of Hormuz to even get to it. So there's some complications there in their military, planning. But the point is, in the meantime, oil's not falling. Yields are continuing to rise with the dollar yen. And that puts enormous pressure. And we haven't really talked about the dollar yen, but that does put a lot of pressure on investors to basically take a serious look at the market and how quickly things have changed, and to move from capital growth to capital preservation. And that's what I think the market is just starting to price in.
I don't think people understand the dash for cash, honestly, from a retail perspective. And before we get into the deflationary discussion, I want to throw something out that I threw out to some people in a trading and financial discussion conversation earlier. And that's that 70% of the retail people, the hoodies and flash crash trading people who all think, oh, I can trade online or on my phone, everything's going to be fine, have never understood or heard the phrase no bid. That's a real crash. And I don't think they're prepared for it. Do you?
Well, most haven't lived through anything like that. We had the COVID crash where we fell February 23rd, 35% in 35 days. And then after that, because the country was shut down and the world in large part, but especially the US, it triggered this influx, this incredible explosion in new traders. So we had 50% of accounts opening, brokerage accounts opening, were women. And we had just tons and tons of new traders, right? And this total, as you know, fascination with zero DTE option trading and the like. And we have had this explosion in trading activity since the COVID crash and lockdown. So they haven't had anything like that, except when Trump came into office in January 2025, and we had DeepSeek. NVIDIA got pummeled 16% in a day, and then slowly but surely, until February, then the waterfall cascade into the April low. And then, of course, policy intervention created that V-shape or right tail rally. So no, I don't think they have a lot of experience, because most of the traders are new. They're going to learn though. It's a learning planet. And honestly, this expectation that markets are going to advance, and I had it as well at the beginning of the year, as long as the dollar continues to fall, objects will appear taller. So that's no question. It will always be the case. But we don't have that right now. We actually have a really firm dollar with rising yields. And in fact, that dollar looks ready to spike higher, which would be in a crash. That's the risk off. So the dollar could actually move from 100.5 into 105 very quickly. And the crash could be forced selling that many are not experienced in trading, but also are not positioned in trading. So I think that this risk of crash is here. Like I've been predicting it was coming. This is the level where it can happen, is right here, right now. And I think one of the things that we have to kind of focus on is this AI in its early innings, so to speak, the past few years, building it out and pulling forward a whole bunch of growth. And you talked about the data centers at the very front of this conversation, is important because it runs on what energy will it operate? Because there are massive capex investment expectations that have already been sunk or contracted for. And now we have much higher costs. And we also have major sponsors who will be pulling their sponsorship, i.e. Saudi Arabia, UAE, etc. These $1 trillion sovereign wealth funds over in the Gulf Arab countries that have absolutely firmly supported and invested in our AI tech ecosystem. I mean, everything from NVIDIA to data centers to you name it, right? Now that is something that is not getting the attention of the tech bulls because they're still very married to their exciting, very productivity enhancing, transitional way of doing business, augmented by AI and this crazed projection forward of growth that they pulled forward, but it is in its early innings, right? So, but the problem is the valuations are extremely high. That needs to be, there needs to be some de-risking there. And you have sponsors, large investors that are being attacked right now. They are being, the Qatar LNG facility that is now force majeure for 5 years at $20 billion a year. That's $100 billion. They are going to have to reinvest in their infrastructure in the countries that are getting attacked. And that money's going to have to get pulled out of the US. And it's going to have to get pulled out of the AI tech investments in one way or the other. So I think that that's one thing, that the higher oil equals lower AI investment isn't being considered seriously. And one more point on that, we can quickly transition from a growth scare, which this is, an energy crisis, rest of the world, maybe US is, net independent for the most part, but the point on energy, but the point is this growth scare can quickly transition into a recession scare. And that hasn't been priced into the market, but a market crash, it does it removes complacency, right? Folks are going to, even at the end of the month, they're going to be looking at the September returns and going, what happened to my gold? Oh my God, bonds are also in the toilet, and equities. My goodness, we've lost a lot of ground here. Nothing's safe, not Mag 7, not software. Data centers and memory are the only two kind of dominions that haven't basically fallen through the floor, but they are next. So I think the higher oil prices are masking what is coming next. Global yields higher, inflation expectations higher, dollar yen higher. It's a recursive loop, pressures equity markets lower. And that's also part of this Iran risk is not priced in thesis that I have been talking about since beginning of February.
Well, I think you and I would agree, and we have agreed online. And folks, you don't understand. Samantha and myself have lots of conversations you don't see. You see conversations all the time. And X sometimes just lets us talk to each other in an empty room. We don't know why. I think she has some fascinating viewpoints. One of my viewpoints, and this is not speaking for Samantha, the ETF issue, the leverage introduced by the number of ETFs, creating false advanced decline line technical analysis, creating this bullish narrative, does work in reverse. So if we were to get a 10, 12% down day, I really think that shock to the system could be the biggest domino, triggering bigger dominoes throughout our financial system. And I don't believe that gets enough attention. People have levered themselves up out the wazoo. That's a technical term, by the way, boys and girls.
Yep.
And when that wazoo gets a cork shoved into it, the pain begins. Please, if you want to take that before we take a break.
I think that the leverage is something that we can actually track through margin debt. And I would have to go find it in my timeline, but suffice it to say, extremely high margin debt is not a reason to short the market. When it starts to roll over, however, it is. And I am of high conviction that it has already started to roll over, and how, without even looking at the most recent data, because I know that bonds and gold and equity, in other words, we've moved from metal volatility, currency volatility, rate volatility, oil volatility. We've hit them all. So the margin calls are obviously coming. And this is something that can actually put, as you just said, an unwind up the yazoo. And we are just starting to roll over again, as I mentioned, in selling under the surface, in breadth degradation that is collapsing. Actually, those are some indicators that I do follow very closely. And we haven't even gotten the zero DTE gang together to press on the short side. It's been typically gamma squeezes on the upside, always looking for the right tail. But the point is, the left tail has not been appreciated. So an unwind with our kind of leverage and exuberant margin debt, which, by the way, the new CEO of IBKR, the largest brokerage firm in the country, last month said it was at a dangerously high level. So he was actually calling the alarm on margin debt to equity and saying, I don't like it here. This is when we get something breaks. So he was right. He was, and this was before, right, Iran escalation. The other part I'd like to talk about is this round tripping and leverage that is in our capital markets. And I have to bring this back to the Gulf Arab countries that are big sponsors of US tech ecosystem. And I'm talking specifically about Abu Dhabi buys private credit from New York City. New York City funds Silicon Valley's AI dreams. Silicon Valley sells the AI hype back to the Middle East, to these sovereign wealth funds. So in the same way we've talked about the NVIDIA, round tripping in the past, that is a cult stock. There's no question about it. And it stays elevated until the curtain is pulled back type of thing. We saw it with SMCI. That's a fraud. It's been a fraud for years. And now finally it's being, shown as such. And the market dumps, SMCI stock dumps 30%. Well, it's the same type of round tripping that's going back to our capital markets, where the Gulf sovereign wealth funds, they make these uber large, uber concentrated bets on AI. This is not just venture investing. It's state level strategy. A state level strategy, by the way, that's going to have to be unwound as well, because they are collateral damage in this war, this US-Israel war on Iran that is attacking their neighbors, is actually now going to require rebuilding. And in the case of Dubai, they might not even make it. So they're attacking the monarchies as well. Right? You get rid of the king, you get rid of the monarchy. So these uber large, uber concentrated bets on AI by these Gulf sovereign wealth funds, this has been converted into our equity market, our AI infrastructure, our compute power, our data advantage, all of it, our CAPEX build out, our GDP growth based on that CAPEX build out. So they were positioning themselves for this. Now they're completely at risk capital flows, oil flows were funding this AI tech sponsorship. Those oil capital flows have stopped. Their infrastructure is damaged and in some cases destroyed. So they're under attack. They're not going to be able to just write blank checks anymore for US equity and for US treasuries. So I think that's what's not being priced into the market yet.
Amen and 100%. And just from my personal view, we have one of the bishops who've been warning about the church of the AI cultists. Just Dario in the room with us tonight, Samantha. So it's very nice to see you, Dario. We look forward to having you on next Friday night. This is one of those situations where you had the cult of the crypto. Remember that?
Oh, yes, I do.
We had the cult of the blockchain. We've had the cult of real estate only goes up. We've had the cult of banks will never fail again, like the 1930s. And we go through these cycles. And folks, when we return after this quick commercial word for first, SamanthaLaDuc.com, SamanthaLaDuc.com. If you are not subscribed to Macro to Micro, Samantha, tell them what they're missing, please.
Well, I actually run a financial research firm. So first, it's LaDucTrading.com. I have a full bench of 10 from classical, economics guru, oh my God, in Jeffrey Fougere, whom I think you also follow, to Chase traders extraordinaire. And we work and support clients wherever they are in that journey, from beginner, intermediate to advanced, and basically work with them live and publish our analysis, trades, and do custom support. I have a mini-me Substack, which is the SamanthaLaDuc.com. So that doesn't include my team at all. That's just my macro views that I share. So just to differentiate, LaDucTrading.com versus SamanthaLaDuc.com. And that's it. I do this whole macro to micro across all assets and timeframes because I want to see how all these correlated, and uncorrelated occurrences for timing, market direction, sector rotation, and stock selection. And right now, this has been a pretty timely pullback. And now this discussion is timely because we've reached my crash level where we need to basically say bond bulls need to defend now, meaning yields are getting too hot, too high. And I don't see, and that's a big reason that we have equity weakness. And I don't see an intervention that's really going to work except for one. And the one that I wrote about for clients is an unfamiliar territory, and it's probably a little bit too early as well. But suffice it to say, the only intervention that I think is going to work, because Iran's not going to stop, and we don't want to suggest that Israel and Netanyahu and Trump are absolutely insane and crazy and evil enough to do nuclear. But that is absolutely a fear. But I think the one let's just say, ceasefire a strategy that would work, and I hate to say it because it's going to also get a lot of, fists in the air, would be China and Russia negotiate a forced armistice with Iran in exchange for concessions. And what does that mean? It means that it paves the way next year, very likely, for China to reunification with Taiwan, and Russia. Putin has already come out, in fact, earlier, and he says Russia will stop providing intelligence to Iran only if U.S. halts support for Ukraine. They're starting, and I wrote about this literally exactly this. And I said, March 19th is the last day of Ramadan, ironically, day after FOMC and BOJ rate decisions and day before monthly March OPEX. Long story short, listen for signs of ceasefire by then. Otherwise, market will move from pricing in a binary event to more of a systemic one. And that's exactly where we are.
And that's what's terrifying. Real quick, everyone, macroedge.net/ozone, macroedge.net/ozone. Get your 2-week free trial. Follow Samantha LaDuc, please. Follow her on X. She and the MacroEdge team have a great relationship. That's why we enjoy having her on, because she brings a different perspective. If you're watching the financial TV networks, you're going to be told again and again, this is a buying opportunity. And by the way, some of us are old. I'm a lot older than Samantha, trust me. I heard it in 90, I heard it in 98, in 01, in 07, and every time it was so they could dump their crap on you, the retail bag holder. Protect your cash, protect your money, get the big picture, look for alternative opinions in financial news, markets, and measurements. That's what Samantha tries to do. That's what we try to do. We don't want you getting buried. And a lot of people are going to lose their retirements having the blind faith politically and lack of knowledge economically to see what's coming. Let's get into the macro picture, because I think it's a big deal. You talked about deflation, which is my big theme for the second half of this year. And Dr. Copper screened a deflationary outcome this week, dropping below 450, dropping below 5 like it was nothing. And now sitting at 537, heading towards 450, in my opinion, and possibly $4. Gold was liquidated to raise cash. Who needs cash? I don't know. If you have missiles falling on you and you can't sell your oil, you need US dollars. So when you see this kind of price action and the liquidation of US treasuries creating these massive moves, thus inflating the price of the dollar higher, one has to ask, we're going to see a macro shift in the next 72 hours where there's a very good possibility we see 160 on the yen again. We see copper continue to deteriorate in price, and another jump in gas prices at the pump for Mr. and Mrs. Main Street. All of those point to a demand destruction outcome for H2. Would you agree with that?
I would, but I frame it a little bit differently. I think that this war is inflationary, that can pull forward recession risk, because oil spikes are inflationary and recessionary. So think 2008, we had to go up before we went down. So we're not done going up. The inflation spike is not over. We could double in oil price here. The higher yield call that I had is absolutely not done. So we first have to go through this exercise of the inflation impulse before we can get to the deflation impulse. I think that the copper silver pullback, both of which are industrial, we've got lots of reasons that gold is sold, as you highlight. It's a collateral trade. But as it relates to economic contraction showing up on recession risk getting pulled forward, you see copper and silver sell off, right? So yes, but I don't call that deflation backdrop yet. Nope, I really think that stagflation that you and I agreed to when we last spoke in October, right, for 2026, was going to be front and center, which means prices rise, economic activity contracts, and employment or unemployment increases, which then puts a kibosh on consumer discretionary income and spending. So that is what then creates later that demand destruction. And we're going to see demand destruction in certain sectors show up early. For example, in the auto sector, we've got Ford and GM as poster child, right? You can take a look at the charts and you can see lots and lots of charts that have seen the higher price in oil immediately pull forward demand destruction in the future. So, because they're, internal combustion engines, they're not EV driven as much, but the whole auto sector is getting hit, Tesla included, because this is a demand destruction event from recession risk. But I still see that as stagflation. Prices go up as the economy contracts, and then later, after this unfortunate, event of inflation hitting us right between the forehead, like we do not need it with rising unemployment, right? And that's the risk. Then we go into the demand destruction phase I don't consider the market falling a demand destruction. In other words, this is money goes home. For me right now, this is money goes home. So de-risking, money goes home. Retail hasn't even started selling yet. They haven't even gotten their end of month statement, right? This started on the 28th, the first bomb, and end of March, they haven't even gotten their statements yet. So retail hasn't even said, whoa, whoa, whoa. Like you said, they're still seemingly buying. But I think tactically, this is going to be market will, Wall Street will definitely impact Main Street as tax revenues fall, as income levels fall. Then we will have real demand destruction, and that will also start to hurt houses. But the housing sector is different because it's an inflationary asset. So you follow this, I know, very, very closely, both unemployment and real estate. And we talked about this last time. I saw the unemployment trends picking up end of 2025 into 2026, and AI isn't going to help that. And then, of course, real estate, because it's our best inflationary asset, we have to have some real demand destruction before the housing market turns decisively lower. And that's coming second half of the year. I would agree with you on that.
I 100% agree, because what I've seen now is the stagflation you and I discussed last time you were on. And the stagflation I'm seeing is we are going to start seeing more asset deflation in things that the retail side owns: equities, bond prices, housing, value of the car you own, assets that you never think would go down again because that's what they were preached to. On the flip side, I think we're going to start seeing the consumables and necessity inflation, including services, continue to creep higher, not just because of tariffs, which you and I ripped to shreds last time, but here we are with the president promoting more tariffs. At the same time, I'll give you a headline that just crossed here within the hour. United Airlines planning for oil to reach 175 per barrel and planning on an immediate cut of 5% of capacity. That is an illustration of peripheral demand destruction, but there's no reason, as long as oil remains above $100 a barrel, for that 5% capacity to be restarted or re-engaged, because the demand won't be there. You wipe out that middle percentile, the 50 to 85, 90 percentile of the middle class in America, their ability to afford things, to buy experiences, you will see, and I think you'll agree, massive tail end demand destruction heading into 2027. And that's where I think we're going to see the deflationary pain really accelerate and begin.
Is he also the one, you're talking about the United Airlines CEO that called for, he sees it basically $175 a barrel. Is he also the one that said we have to cancel flights to Asia because we have risk that we can't refuel in order to turn around? Or was that a different airline? That was also today, but I get you.
I believe it was United also. I believe it was United also. Yeah, there are numerous airlines starting to pare back their Asian routes because Vietnam has run out of aviation fuel and no one will loan them any. Thailand has restricted it purely for their internal use. And many of the Southeast Asian nations are restricting it purely for military purposes only. So we're starting to see the emerging market destruction. Which everyone said was the thing to invest in at the tail end of last year.
This is true.
Begin rapidly.
But this was definitely before the war, because it was working well, right? Especially in Korea with their memory stranglehold of stocks that feed the AI ecosystem, and NVIDIA in particular, in general, and then NVIDIA in specifics. But the point is, yes, now they are importers. 95% of their energy is imported, and it's going to take a hit in Korea. In fact, that Qatar LNG facility that just claimed, force majeure for the next 5 years, that hits hard, not just EU countries like Italy, Belgium, but also specifically Korea. China has also closed the door as it relates to exporting any refined products, which is why Thailand and Vietnam are going please send us something, because they're completely dependent. So they're dependent on China. China's saying we're not selling anything. we're like, nope, because we obviously we have a problem, and they're hunkering down. So that is what you're talking about for sure. It's going to impact. Airlines are the first to go down. Refineries in the U.S., those were the first to go strongly higher. So there's a lot of collateral damage that's known that we can see. What we can't see are the capital flows that have come from these oil-rich nations that are stopping and reversing. And that's the threat that I'm most focused on, because of the concentration risk in the S&P, which will be 50% cap weighted once we get Anthropic, OpenAI, and SpaceX through their IPOs. Boy, did they pick a lousy time to go public, right? So that exit liquidity would have been much better last year. But nonetheless, that is the concentration risk that I focus on. Where are the buyers going to come from if they're busy, in their own homeland? Money goes home, and that's what's happening right now. And I think it's just started.
Well, adding to the macro picture on this, because this is big, and Dario will appreciate this, because he and I have talked about this, and this is a huge picture that no one pays attention to. You're watching the flows. I'm a commodity guy. I'm a logistics guy. We have 5% of the VLCC fleet tied up in the Persian Gulf right now, can't move. We have 1,000 U.S. sailors sitting on vessels in the Persian Gulf, running out of food and water. We also have no helium moving from Qatar or Kuwait to South Korea or Taiwan for the manufacturing of semiconductors. If we can't make semiconductors, or we have to reduce production levels, I would love for anyone to tell me where the production levels on a United States semiconductor factory will make up for the loss of the two largest nations for semiconductors, not counting Malaysia in the mix, how they're going to recover to meet all of their revenue goals, unless NVIDIA is going to resell the chips in its warehouse in Singapore 5 times over again.
Yes. And they just lost one of their quote unquote partners in SMCI, who is famously, we knew this was going on for years. So, and Dario knows that firsthand, because he's done exposés on SMCI and NVIDIA. But yes, long story short, the best trade that hasn't happened yet is short semiconductors, no question. Whether it's Taiwan Semiconductor, NVIDIA, AMD, they are the darling, they are the golden, children of this AI world. And they seemingly are untouchable with the memory stocks and the data center, again, because the AI repricing hasn't occurred yet. They came for the airline, for the airplanes and the cars first, but now it's going to start and spread a little bit wider. But yes, in your comment around helium, don't forget that's part and parcel, very, very important for the chip AI world, but sulfur as well. We've got a fly in the ointment there. I'm quite sure Trump didn't think this through, right? So we got 92% of the world's sulfur comes from refining oil and gas, and you lose that feedstock for the most produced chemical on Earth that goes into extracting copper, which, by the way, is needed for those data centers, right? It's needed for EV batteries. That's also extracting of cobalt. Without this sulfur, this feedstock for sulfuric acid, we can't get these data centers built. So it is shipped through this choke point of the Strait of Hormuz. So it's a big deal. And Qatar, that ships 30% of Taiwan's LNG right through the Hormuz, also means that Taiwan Semiconductor Company, that makes 90% of the world's advanced chips, is down its LNG, its sulfur, its helium. Come on, how is that not a gorgeous short?
It's a disaster waiting to happen. And the other issue is the third world countries that mine those products. And this is a big term. I'm not a scientist, but I do have a head on my shoulders. Sulfur is required for sulfuric acid, which is required for mining and processing tungsten and cobalt and many of the rare earth minerals that the United States does not have enough of to make weapons of war. That goes into the geopolitics section. But from an investing perspective, if you really think China or Russia are going to share their strategic reserves of these items, you're out of your damn minds.
And the same thing for Canada. By the way, they have a ton of sulfur, but it's not something so they produce it. They stockpile it, lots in Alberta. It's literally visible from space, but they do not distribute. It's not their system. They don't have a system. We had it already, right? 92% goes through the Hormuz. So we didn't need Canada's. And Canada isn't set up to be a global exporter of this critical mineral. So Canada's in a better shape, by the way, just because of that as well. But the more important, for me anyway, isn't just sulfur and semiconductors and helium, oh my, but food. So we've got a food insecurity, fuel insecurity, and now AI de-risking threat. But 33% of the world's nitrogen fertilizer is moving through that strait, and there are nations that are wholly dependent, not just within the Gulf, but beyond. So it's becoming a humanitarian crisis. It's not just a market commentary show, right? We're focused about how to protect capital, for our clients. Anyone listening kind of knows that this is a big deal, but they still think Trump is going to somehow get us out of this mess. I wrote early and often, no, this is a protracted Middle East war. This is going to be an Arab Spring 2.0 risk. And by that, do you remember what happened in Arab 1.0? Post 2000?
I was there all over it, and most people don't understand that the Arab Spring, albeit some of it was artificially generated, changed the face. And by making the Ayatollah a martyr, we have lit the fuse on something we don't understand in the Arab Street or the Islamic world, which, by the way, boys and girls, stretches from Morocco past Malaysia far more than people understand.
And it's also very inflationary, but this is something that creates civil war from an Arab Spring. So just to kind of remind a little bit, we had back, 2008, when also an oil spike, by the way. Yes, remember that. Above this key level is why I keep really, really focused above 100 or 80, 90, really at a core level. This can turn from food insecurity to worse. Humanitarian crisis is the only word that I can really come up with, honestly. So how will this work? Motivations are, hard to identify because he's mercurial, but how will Trump really de-escalate? Not just talking about it, but doing it, when obviously Netanyahu has other things in mind. And this is also becoming more and more apparent every single day. And that's a bigger war that U.S. wasn't signed up for. So Trump has really trapped us. And I can't help but kind of wonder where this is going to de-escalate. But if it doesn't, we're going to see much lower levels. And that's not what folks were pricing in after a rambunctious 2023, 2024, 2025. It's midterm elections. It's seasonally strong. We've got 8,000, on SPX price targets by, many, many houses. They haven't even revised lower, by the way. One revised down to 7,700 today, right? So we're supposed to somehow pop up like a daisy again, that right tail risk. Color me skeptical, just color me skeptical. But we had an Arab Spring 1.0 in 2010, following the great financial crisis. It ushered in food price inflation from the 2008 oil shock. It's going to do it again, but it's much bigger and it's more widespread. So that is exactly what you just pointed out. That shock created an uprising and instability. And I think this one will pale in comparison because we're also at war and we're bringing in neighbors, right? Trump is trying to enlist help from Japan and NATO, and it's just a cluster.
Well, that's understood. Samantha, we have had our first hour. Do you have time for another 10 or 15 minutes? It's up to you. We don't like to keep our guests longer
No,
than.
I'm fine.
Oh,
if anyone has
fantastic.
questions,
Folks, fire questions through the macroedge.net thread. We're going to do it that way, but I have got to sit there and remind everyone, LaDuc Trading, LADUC trading.com. Sign up, make money. Don't get caught getting smoked like retail is about to. And at least get on our Substack, people. Get the free version at a minimum. It costs you an email address. Wake up. See what's coming. Samantha and I talk on X all the time. You're going to see what happens when people miscalculate at a massive level. And when I say a massive level, I have breaking geopolitical news. Samantha, are you ready for this one?
hit me.
Iran targeted Diego Garcia with ballistic missiles today.
Oh, isn't that in UK?
South Indian Ocean.
Indian Ocean. Okay, so there's another UK base where.
That's it. That's theirs. That's the British base.
Okay, so this is the one in Indian Ocean. Thank you.
Yeah,
Wow.
yeah, it's near Mauritius, which I was planning on visiting. Didn't look so attractive right now.
So this is the UK giving permission for UK.
Oh, no. This is Iran attacking an American base on Diego Garcia.
Yes.
And people are freaking out.
Yeah, but I understand why. It's because the UK said US can launch missions from these bases. That's why Iran is targeting them.
Oh, yeah. Oh, it's just the beginning, though. It gets worse. They just warned Romania that if they don't stop allowing U.S. military aircraft to transit from their bases there, that they will attack them. So it is expanding into a global war. And folks, I have a theory for this, and I want to hear Samantha. We're going to go into the geopolitics of this a little bit, because for the first time in a long time, geopolitics is in the driver's seat. If you wondered what life was like in 1914 or 1940 when things spiraled, I think we're in the spiraling phase where we've lost control due to irrational decisions by arrogant leaders who didn't think this through. And we're starting to understand how severe this is becoming when you see people believe that oil can be turned off and on with a light switch.
Yeah.
When you see people think that the SPR release is some sort of magic panacea for what's happening, and when the American people think that we're safe from an attack anywhere globally, travel is going to cease. The United States is no longer an island, and we don't really seem to have a good comprehension or base for what we're engaging in. Israel, for all their stupid decisions, this has to be the dumbest one ever, which could lead to destruction of their nation. Unfortunately, they have a submarine off the coast of Oman. They could start even bigger things. I fear that we're looking at a cascading series of events leading to a global war. And boys and girls, once that occurs, Taiwan's gone. That's an easy occupation for China, despite all the hubris we hear from Taipei. And for Russia, they can just sit there and watch and collect paychecks. Where do you see this going from an economic perspective? Because the geopolitics is now driving economic demand. And once people actually get scared to spend, they stop spending.
I don't have a crystal ball, and I don't want to live in that space of fear. All I can do is project what meets the smell test, the mom smell test, which is there are motivations for Trump and Netanyahu to attack Iran, all contrived, in my humble opinion, that does not benefit the US at all. It hurts us, plain and simple. So there's nothing good that can come out of this. I have colleagues, friends, clients that all say, no, this is, we're in a good direction. We're going to remove this threat and we're going to get this choke point free, and we're going to be in a stronger position because it won't ever happen again. And I keep going, what would be their motivation to do that? They're martyrs by nature, and Israel is the one that is the nuclear threat, more so because they want what they want when they want it, and we're not going to live with Trump as our president in a state of peace, despite him campaigning on that. And this is going to only result in war until he is removed through potential midterms that flip, and then they impeach, and they get enough, they have enough material, right, from the grift to the action here that is, again, without Congress, he needs money to approve this in his 60 days from the start of the mission. So he's got his time that he's going to engage, and then he's going to create some false flag, likely in the US, likely with DHS not being funded right now because it's the Dems' fault, and that will then be blamed on the Dems to hurt them in the midterms. I mean, this is all contrived motivations that we can kind of see in the making. And so I just wait until they happen, and then I go, okay, what's he going to do next for the next agenda, which is escalation. I don't see any potential of this resolving peacefully unless, like I said, the outlier event, which is China and Russia, come in to negotiate a forced armistice. But that might not happen until next year. China will have its reunification with Taiwan, period. This is a way potentially to help Trump potentially get this mitigated, so it'll be a smoother transfer of power. Russia with Ukraine, he's already made the bid today. We'll help you with Iran if you give us Ukraine. So, I mean, they're already starting behind the scenes. I don't know which way this is going to go because there's so many ways it can go sideways. And that's the risk. This is this is an agent of chaos we're dealing with. So if anyone thinks they know how this is going to go, they really don't. I can see the selling in the market, right? I can then look for a macro narrative to attach to it. But the reality is this crystal ball is a little bit foggy. And we still have, by the way, Epstein files that have not been dealt with because we had this distraction, this well-timed distraction. And we don't have let's just say a path to peace without concessions. And those are going to be really, really big deals, like you just started off with Taiwan. I don't think there is a resumption of a resolution anytime this year. I can see some, and I saw volatility just from a technical standpoint because my job is market timing. I told clients in advance, I saw this value rotation from November, December, January, and February. Then the rotation into volatility, in lieu of sector rotation, there will be volatility. It's a mantra of mine, March through May. So I already saw the volatility coming in. I just didn't have a reason for it. Well, I can tell you, I still see it through May, and then stabilization in the summer, and then more in the second half of the year. So I don't see this as something that, even if we think we've got some calm in the markets this summer, it will come back up, bubbling up toward the end of the year. So that's what I see. And we'll see what happens.
I love it. The mom sniff tests. I love that one. That's great. That is so awesome. I'm going to go here with the left tail risk, and that is the fact that it looks like we're moving ground troops in the region for an intensification to levels we haven't seen in 80 years. And that is the major tail risk, even if it's just Lebanon or a foolish attempt for our own Gallipoli on Karg Island. That would result in a situation that markets have never prepared for or experienced since 1941. And that's terrifying. So, folks, hedge yourselves is what I'm saying. I'm saying have a hedge, have a plan.
Yeah, here's another thing. U.S. has not won a war since 1945. And you know how we did it, right?
The same way Israel will.
Yeah. So this is the real risk. U.S. is bravado. And this Hegseth, macho, chest-pumping, religious zealot is trying to feed us a line of Islamic phobia and, victory at any cost. And oh my God, the U.S. has not won any war since 1945, and you know how we won that one. So to me, it's totally dangerous, but we have to trade what's in front of us. And right now, the market is just starting to sell underneath the surface before the actual selling occurred. This is what can pick up speed unless we get some calm, some peace, some ceasefire, some forced armistice. I don't see any signs of that right now. And that is absolutely reason to take care, to potentially, as I warned clients on February 3rd, we're going to have volatility. If you don't have the stomach for it, step aside, get out of the pool, let it fall. I'll let you know when it's safe. But right now it is not safe.
Well, we have listener questions, and I'm not going to depress anyone with a 20-minute diatribe about the danger and history of Shiite revolutionary militarism from the 8th century forward, because you guys would hate me. So let's get to some serious questions about markets, because Samantha, I'm sorry, I'm a history major from the Middle East. I guess
I'm not, so thank you.
Yeah, so I don't want to make your eyes bleed either. I like my guess. First question. Energy did great today amidst volatility, while other beneficiaries, such as chemicals, et cetera, were down. Do we expect everything to get whacked while energy rises, or also chems, spurts, ag, et cetera, bouncing back or declining further?
So energy as it relates to, for example, XLE, the ETF, or oil price, because oil price is staying elevated even despite intervention because of risk war premium, no question about it. And the fact that this is going to last a lot longer than is priced in. The oil and gas companies, and specifically the refiners, highly recommended, by the way, to clients in January that XLE would outperform the S&P, for example, is still working. It can't go up in a parabolic nature forever, but it can absolutely outperform. And there are some stocks within energy that are supremely positioned, like refiners, et cetera. So it isn't about one day. It's about a trend that is durable and that is in play. So energy is outperforming the S&P clearly. Now within the ag sector, there are commodities, wheat in particular. In the US, we also have a little advantage here. Brazil is not selling right now, despite a bumper crop that would normally suppress the price of wheat. So we have a lot of countries that are just battening down the hatches, right? They're not exporting refined products, grains, et cetera. So we have to kind of do this on our own. Fertilizer, there are plays that have been violently successful because of what's happening in the Strait of Hormuz, and the such Dow Chemicals and LYB Chemicals, US-based providers, are now coming up from the dead after years of protracted downtrends, and others like them, because their competition has been taken out. So the specialty chemical providers in the Middle East, Bahrain, aluminum, et cetera, they can't sell right now. They're in a war, not by their own choosing, right? And by the way, Bahrain has not fired one missile despite getting pummeled, because they know that if they do, that's a bigger problem for them. So they're just sitting ducks. They're just sitting ducks. So there are certain commodities that are better than others, like we've already talked about. Copper and silver more industrial. They're succumbing to selling also because of speculative unwind, but also because of economic contraction that occurs with a war that is inflationary and recessionary, and demand destruction is next. So I don't see any problem with staying long energy and short the markets. Long story short.
Well, I can tell you now, about any nation which hosts American bases is now considered fair game by the Iranians. So that's why you're seeing Bahrain, Qatar, Kuwait, Saudi Arabia, et cetera, being pummeled. And the best way to decapitate your enemy is to take away their economic capabilities. And so far, Iran has studied the advice of their Chinese and Russian advisors to a T. And that should really concern us if we ever got into a fight with China, because they would kneecap us instantly. Let's go to the next question. Oh, they haven't even fired a shot yet, and they've kneecapped us.
Exactly. They're letting Trump shoot himself, basically.
Absolutely. Yeah. Got another question for you. Request reviews on Indian equities, as the FII are selling since the last year or more, but the domestic institutions and retail folks in India are buying. Is there an opportunity there? And it's a great question because they tried to play the middle and it blew up in their face.
Yes.
I'm curious to hear your takes on that.
That's a no touch for me. Not the question, but the stocks. So not only are, exactly, right? The PM is playing both sides and he's aligned with Israel. They buy, weapons from Israel, not to be trusted for the most part. And the market is getting hit because they're also energy dependent, and their restriction of, again, not restriction, but the supply hit to food and fertilizer, and not to mention U.S. immigration policy that has kicked back lots of Indian H-1B visas, not to mention AI replacing a lot of engineers that have come from India. So no, I think the backdrop is guilty until proven innocent as it relates to the falling knife. I wouldn't catch it. I don't think it is safe for all the reasons, politically, economically. It's absolute tight correlation to U.S. tech. It's absolutely in a bad place. I'm not a buyer on Indian stocks.
Yeah, and I don't think people understand something. The United States can't resupply India. We can't fill their energy needs. We're too far away. It's half a world away. I know people look at a flat map of the world and think, oh, well, it's only around Africa, et cetera. It's 30 days sailing, boys and girls. And it's not an immediate fulfillment policy. Same problem we have importing goods from India, which we have substantial imports from India. So we talked about demand destruction. I'm going to throw this out if there's no more questions real quick. Another bit of breaking news. Egypt has introduced electricity rationing effective immediately.
Yeah.
9 p.m. to 6 a.m. Yeah. And they are totally dependent on Saudi Arabia for their financial existence.
And food.
So if we see Saudi Arabia kneecapped further by the Houthis attacking Yanbu and the other Red Sea route, I'm afraid we're going to see the destabilization you talk about expanding all through North Africa, again, not Algeria, but also through the entire Middle East. And people think that doesn't impact the American economy. But you did a great job of outlining the one thing I think the Trump administration has ignored since Liberation Day last April, and that is how the global supply chain functions. And it is all tied to the macroeconomics of the world and our system. If we didn't sell our bonds, we didn't have the dollar as reserve currency, it wouldn't matter. But this is looking more like the 1956 Suez Crisis, which marks the end of the British Empire and pound sterling, rather than a change in just global leadership to a multipolar world. It looks like we're on a path of destruction. Love to hear your thoughts and implications on that.
No, I think you summed that up much better than I could. I have believed that one thing Trump would do, it was a feature, not a policy, of debasing the dollar. Now, right now, we're in a risk-off scenario, which triggers a higher dollar. But once this reverses, it goes lower, a lot lower in my estimations. So that summary that you just gave is, in fact, the precursor to what that would accomplish. Why would I think that Trump sees this as a feature, not a bug? Because of this ginormous debt that we will inflate away with a lower dollar. So this is something that I wondered, actually, in the back of my mind, was this all part of a plan? Am I giving him way too much credit? Anyway, regardless, this is going to be a protracted Middle East war that will hit our currency on another quarter, not this one, lower. And I think that your representation of this Arab Spring 2.0, rolling larger regional ramifications are in fact triggering even more reason to sell U.S. equities, U.S. treasuries, and ultimately devalue, debase, de-dollarization for our U.S. exceptionalism and hegemony, which, by the way, this whole war is the opposite of U.S. exceptionalism. So it is definitely going to impact our standing and help China as much as Trump thinks that's his hubris, as much as he thinks he's going to hurt China or somehow have leverage over China because he's taking over Cuba or Venezuela or the Panama Canal or Greenland or Iran. They're really decoupled. They're in a lot better space than I think he gives them credit. So this is actually hurting our allies and helping China. And I see that. I still see that as blowback will be harshest on our U.S. assets and ultimately economy.
Well, I'm going to close the program out with my big question for you because we have so much fun with this. And thank you once again for your time and patience for this program, Samantha. Samantha LaDuc, LaDucTrading.com. The bigger point that I want to make on this is that China has the ability to export deflation because they can manufacture goods cheaper than we can and the rest of the world can. Well, we have to import deflation or we have the inflation that we're experiencing now that Samantha's been highlighting. With that in mind, in your opinion, when we see a 486 or even a 475 10-year, do you believe that Secretary Bessent will use his powers to force the Fed and the Treasury to institutionalize and impose yield curve control?
That
without revealing your research notes or getting you in trouble with compliance. Sorry about that.
No, I don't. The compliance isn't the issue or getting in trouble. It's actually being able to answer your question that I can't, because it isn't about rising yields, which I can very clearly see, and dollar and oil there, all in the basket together. The response that, or the levers that Trump and Bessent have to pull, they will try it all. They will try liquidity, but that's inflationary. So they will potentially, obviously Fed is already doing their programs, several, one to calm the repo and money markets since December 1st. They're throwing money out at the Treasury is also buying back bonds a little bit at a time, 15 billion here, 15 billion there. But over time, they're trying to manage this deluge of supply. Now you have term premiums spiking on inflation expectations and war premium. So they've trapped us, right? So yield curve control a la Japan, that's one way we could go. Another, it is where, a fund blows up, but they kick the can, they run a Japan playbook, right? The problem, I don't see that right now because we have so much of foreign holdings in the U.S. equity and treasury market. a good 25% foreign holding of U.S. equities. So they have their own levers to pull. They get that money and they go home. So I think it's a little bit harder for a yield cap control move. And I think it's massively inflationary. So I think it would have the opposite effect. Remember how folks were so surprised when back in September of 2024, Fed came out and did an emergency 50 basis point rate cut and yields spiked higher, 100 basis points? Yeah. So that's all that transition from monetary dominance to fiscal dominance. And that is basically showing you that the bond vigilantes are in control, not Besant. And again, we had another cut cycle and yields went higher. So the Fed isn't going to be cutting until we have a real deflationary, event that, again, they'll be behind the curve until we have like a 2008 type of crisis or crash, which, by the way, would result in demand destruction getting priced in both oil and yields, right? So until we have a 2000 type 8 event, I don't think yield cap control, even if they talk about it, is going to do much. And for them to actually try and implement it with dollar swaps and with the repo madness and with the massive supply on the short-term treasury T-bills that constantly have to be financed and rolled, and the ever-spiking war engine that contributes to the fiscal deficit, which is going to hit $40 trillion in a New York minute kind of feel, right? It's not something I think will work. I think anything that Besant tries from monetary dominance thinking is going to create even sharper inflation. So I don't think it's going to work. I think a 2008 type of action will, however.
And that's the scary part, because we're artificially keeping our financial institutions afloat by not enforcing the law. We're artificially keeping the housing market afloat by not enforcing the law. And we're crippling people who are the holders of those assets, of those investments, by giving them this false hope that you're at par when in reality you're far from it. Samantha, please promote your social media and website once again.
But also, SEC is considering not forcing companies to do what they've always done, which is have quarterly earnings reports. This is another way to obscure the truth and also perpetuate insider trading and fraud. So they're trying to cover up the decay through more financialization, and this always ends badly. We just don't know when. So it's not an if, but when scenario. And right now we've got a lot on our plate with just the escalation and its impact on capital markets, economic growth, unemployment, peace, safety, goodwill. We have a lot of work to do, and it's going to be a tough year. Thank you very much for the time. You can find me on X at Samantha LaDuc, a mini-me project on Substack at SamanthaLaDuc.com. Again, I run a financial research firm with an amazing desk of superb analysts and traders. We support and engage every single day. This is our love, our passion. So you can find us at LaDucTrading.com.
Samantha, thank you so much. And I look forward to talking to you again when I get back to the island, from the islands in a few months, if I come back. Who knows with our airlines, right?
Why move if the currency is stable? Okay, best of luck to everyone. Have a wonderful evening and rest of the weekend. Cheers.
Thank you for your time. One more time for ourselves. MacroEdge.net/Ozone, 2-week free trial. MacroEdge.net/Ozone. Tuesday, we might have a special guest. Stay tuned to MacroEdge on X for an update. Next Friday, just Dario, we're going to talk a lot. And hopefully we can get some of the other folks who've been behind this and exposing the fraud known as the AI industry on the air at the same time. For MacroEdge.net, this is John Galt. I hope everybody enjoyed MacroEdge Radio tonight. Have a good evening.